Peter Boolkah here, and welcome to today's edition of the Transition Guide. In today's episode, I want to look at cash, and more importantly, cash conversion. See, I cannot begin to tell you the amount of times that businesses use cash in the wrong circumstances and then run out of cash. I'll give you a great example. Often I'll speak to entrepreneurs and they'll say, yeah, I'm reinvesting my money on growth. So there's a big difference between reinvesting your money and reinvesting your profits. Now, I'm a firm believer and a strong advocate that if you are, reinvest your profits in order to grow your business, absolutely. But what you do with cash, well, that's totally different. And I've got a couple of examples of clients where we're in a high growth mode. So again, 30-40% per annum growth, takes up a lot of cash, and they're making some significant purchases. So either it's an office move or it's a purchasing of new manufacturing equipment, whether it's CNCs, whether it's a graphics company that are actually buying a bank of the new iMac Pros. You're looking at investment, well, for an office move, that particular client is looking at about £500,000 investment. CNC machines, you're looking at about £140,000–150,000 investment, and a bank of new computers to do sort of high-end graphics work, you're probably looking at £80,000–90,000. And all three companies at this moment in time are cash rich. To the point, the one that's doing the office move has got around 1.8 million in the bank. So at that point, when you've got 1.8 million in the bank, it probably thinks, okay, well, I've got the money to spend it, spare, let me just go and flash the cash and use my cash. No. Number one, if you're having an office move, always ask the question, how long do you think you're going to be in this office? Now, my client reckons about 5 to 10 years. So you're going to get 5 to 10 years benefit. So why would you want to pay for it all in one hit? Why not take out financing? And a lot of people have got aversion to finance. I don't know why, but they don't want to borrow money. Now, if it's at 8, 9, 10%, I can understand why you wouldn't want to borrow the money. And actually, in the past, interest rates have been much higher than that. But look at where we are the here and now. You're never going to get money as cheaply today as you're ever going to get. I mean, right now, prices are rock bottom. If you're smart, you shop around, you can get some great deals. Obviously, in order to get those great deals, you need to be attractive to the bank. It's quite interesting that those that don't have money, that desperately need money, they get shafted by the banks all day long. The bank will charge them much higher interest rates, plus this charge, that charge, and the poor business that can't afford it's getting screwed. Now, the business that's got money in the bank, that goes to a bank and doesn't need the money, well, all of a sudden, they're a great prospect for the bank. Because how do the banks make money? By lending. Now, if you don't need the money, but want the money, and you go to a bank, and let's say you got 1 million in the bank sitting there, guess what? They're going to be banging themselves. They're going to be sort of rolling all over themselves, wanting to throw money your way. Because for them, you're a sure bet. So remember, when you've got cash in the bank, you've got buying power. And I'll always say that no matter what your turnover is, if your turnover is 1 million, 10 million, 30 million, always have 10% of your turnover in liquid, unencumbered cash. That way, that gives you options. Because a lot of people get caught out when they're high growth businesses. I've got one right now. Thankfully, they've got a lot of cash in the bank. And they're going to need that cash because we're going to be doubling our staff in the next 18 months. So we're going to go from 40 to 80 staff. Can you imagine? You've got recruitment fees, you've got the hiring, the onboarding fees. It's going to be a period of time before they sort of fully settle in and they're churning the money that we need them to churn. Well, the cash has got to come from somewhere. Because they've actually financed the right areas of their business, they've got the cash now for people growth, which means hopefully we'll be able to have a smooth transition, be able to get the people that we need when we need them, and not be restricted by cash when it comes to growth. And too many businesses out there, they've got the potential to grow big, they just don't have the cash to do it because they've spent their cash inappropriately, and often, not everybody, but so many businesses have spent their cash inappropriately. They just cannot afford either to get the raw materials, get the stock, get the people, and they're stuck in that vicious cycle. Don't allow that to happen to you. Now, if you want to take dig a deep dive into the cash of your business and maybe look at what strategies you can adopt to get a much healthier cash flow position, head over to Boolkah.com and get in touch. And always remember, failing to learn is learning to fail.